In this video, I'm going to test a triple moving average strategy on euro dollar on a 15-minute time frame. I first saw this strategy on another channel on YouTube where the guy also tests it, and he tests it manually over 100 trades. From experience, I know that this strategy is very unlikely to be profitable in the long term on such a small time frame. Trading off just a 15-minute time frame, there's going to be lots of trades, going to be in and out quite a lot during the day. And even if there is an edge in the strategy, all the profit is probably going to be eaten up by costs, normally in terms of the spread. Anyway, because I'm able to program the strategy into the trading software, I'm using multi-charts, I was able to quickly run a back test and show you some results for over 8,000 trades. We'll look at those results first, and then I'll look at changing the reward to risk ratio to see if there's any further improvements to be had there. After that, I'm going to change the time frame. I'm going to look at 4 other time frames, all on euro dollar, test them, see which one works best, and then as a bonus, I'm going to use the daily time frame, and I'm going to test the same strategy across 7 different Forex pairs, all on the daily time frame, so we can see exactly what pairs this type of strategy is suited to. All of the testing is done using Oanda data from January 2008 through to May 2022, and I'm using one full lot or 100,000 units of Forex. Let's first have a look at the rules, and I'll show you some examples on the price chart over in multi-charts. So the first thing you want to do is apply 3 different exponential moving averages to your chart, and you'll see we've got the fastest in red here, then the cyan, and then the slowest in white. And these moving averages are a 200 period, a 50 period, and a 20 period. Once they're on a chart, we want to see them in line. So for a short trade, we have to see the 20 lower than the 50 and the 50 lower than the 200. So they all need to be facing downwards and one below each other. For long trades, it needs to be the opposite. The 20 needs to be above the 50 and the 50 needs to be above the 200. Once we see that, I've got a couple or 3 example trades for you here. Once the moving averages are in the right configuration, so 20 under the 50, etc., we're looking for only short trades. And we go short when we first have a close which is above the 20, but then we want to see a close back below the 20. So this is the bar here, this is the close here, where previously it was above the 20 and then it closed below, and then we sell short on the open of the next bar. Here we just took profit. Here, for example, the price penetrated up through the moving average, but we don't take the trade because there was no close. Here we see we've got a close which is above the 20 and their close back below the 20, so we take the trade. Again, here we've got closes which are above the 20, and the minute we get a close back below the 20, which is here, we take the trade, sell short on the next open. Now for the stop loss, what was suggested was looking at the latest swing highs or swing lows. So we're looking at swing highs in terms of short trades. So that would be around about here, because this was the latest period of swing highs. It's quite hard for me to program swing highs, so what I said was I want to look at the highest high over the past 5 bars, or a stop loss for long positions, we want to be looking at the lowest low over the past 5 bars. And if I show you, look at this trade here, so we shorted here and then we actually hit the stop loss. If I put the line where the stop loss level is, you can see that it was this highest high here, because that was the highest high over the last 5 bars before we entered the trade. So the distance between the stop loss and the entry point is the amount of risk, and the profit target is just a multiple of the risk. So if we were risking 120 pips and our profit target was a 1-to-1, then the profit target would also be 120 pips. We're going to test the different profit targets. First, let's look at the results using the suggested 2-to-1 profit target, and we're looking at the 15-minute time frame of euro dollar. That's what the equity curve looks like going back to 2008. So while you can see that it hasn't actually made money over the whole period, it certainly has been making money since around 2015. And this is a point I always like to make. Although overall this probably looks quite a bad strategy, even bad strategies can sometimes have some good looking periods. So that was a 2-to-1. But let's do a quick optimization to see if 2-to-1 reward to risk ratio is best. So I've done that optimization, and you can see we've got an input here, my profit multiple, and we've gone from 0.5 through to 5. So 5 is a 5-to-1 reward to risk ratio. And we can see that they're all losing money, but the best, or the one that actually lost the least amount of money, was actually the 2-to-1. So whoever originally suggested the 2-to-1 has probably got that about right. However, there is one thing I want to show you. At the moment, I haven't included any costs in this strategy. Now, I suggested at the start of the video that on such a small time frame that trading costs can eat up any profits on a strategy like this. And I'll put in some costs now. Even if I put a bare minimum of $10 in and $10 out, so a total of $20 per trade, which is 2 pips, which is really, really the bare minimum for euro dollar. We're probably going to experience more costs than that. Let's see how that looks. Now that's what the equity curve looks like, just with the bare minimum of 20 pips total. You can see it's a complete money losing strategy. So although in the previous equity curve without the costs, we saw that it did look like it had an edge or it was making money from 2015, as soon as we apply the costs, we realise how small that little bit of profit was. And once we are paying costs, we're not going to be making money at all. But I was determined to find something that works for you guys. So the next test, we're going to be looking at the same strategy on euro dollar, but on some other time frames. Now we're going to be looking at 30-minute, 60-minute, 4-hour and daily time frame. So this time we're going to be looking at multi-charts portfolio trader, which is quite clever because it allows us to run the same strategy across multiple time frames or multiple instruments, like we'll have a look at that later on. Let's first look at euro dollar over 30, 60, 240 and 1440 minutes. Okay, they're the markets that I'm running all the same strategy on. So looking at the backtest report, that's the equity curve running all of the 4 separate time frames. But let's have a look at the individual time frames. So this top one here is 30-minute, then it's 60-minute, then it's 4-hour or 240-minute, then it's the daily or 1440-minute. And we can clearly see that only one that's making any profit is the daily time frame. So there's the equity curve looking at the daily time frame. And although it's not the greatest, I mean, it's definitely making money and moving in the right direction. I haven't got any costs added into this, so we need to take into account the size of the average trade. But this time, with an average trade of $320, we're still going to be making a lot of profit even after we take out maybe $60 worth of costs per trade. And this strategy is using the reward to risk ratio of 2-to-1. So it looks like with euro dollar, the only thing that's possibly worth trading is trading that strategy on a daily time frame. By the way, if you are looking for some strategy ideas or some strategies which have been proven, then you can get my 22-page Beat the Market Strategy Guidebook. And in that guidebook, there's 3 more profitable strategies. And I'll give that away for free. I'll leave the link in the description down below so you can download that immediately. Better still, amongst another wealth of vital information and knowledge, I list out 6 more strategies in my trading course, and those proven strategies, and I even give you the multi-charts code so that you can then use them yourself in multi-charts or trade them manually if you like. They're all manual tradable strategies. If you want to have a look at that, I'll also leave the link for that down below. So our final test we're going to do as the bonus, we're going to look at the same triple moving average strategy with the 2-to-1 reward to risk ratio, and we're going to test it across daily charts of 8 different Forex pairs. And again, I'm using multi-charts portfolio trader to do this. So you can see here the markets that we're looking at, all on a daily or a 1440-minute time frame. So that's the equity curve showing trading every one of those Forex pairs all on the daily chart. And you can see that, yes, it makes money. Not the smoothest equity curve, but it does make money. But I'm sure some pairs are going to be performing better than others. We can have a look at that by looking at the breakdown of the symbols. And we can see, looking through here, that actually only 5 of these pairs make money in the long term. Euro dollar, we've already seen the results for euro dollar. But pound yen makes money, pound dollar makes money, US dollar Canadian dollar makes money, not a lot, and US dollar Japanese yen also makes money. Let's one by one just have a look at the equity curves. You've already seen the equity curve for euro dollar. Let's just have a look at it again. Remind ourselves that's euro dollar. Pound Japanese yen, there's the equity curve for that one. Pound dollar, there's the equity curve for that one. US dollar Canadian dollar, that's not very good, is it? And lastly, US dollar Japanese yen, there's the equity curve for that one. And again, these are only using that 2-to-1 reward to risk ratio. Perhaps there's a better reward to risk ratio which can improve the results on the different markets even further. Wrapping up this video then, we've seen that the time frames less than or shorter than daily time frame on euro dollar haven't worked very well at all. The daily time frame, whilst it is consistent, possibly something usable, something you might like to trade. You've seen the results. Then, out of the other 7 markets that we looked at using the daily time frame, another 4 of them, or 5 in total, actually made net profit, but we've seen some worse than others. You've seen the results. You make your mind up whether you want to trade any of those. Let me know if you have any strategies which you'd like me to test. I like doing these types of video, and I'm hoping that they're going to be quite useful for you guys too. The strategies do need to be 100% rule-based so that I can program them and have multi-charts do the testing very quickly for us. Next time, I'm going to be looking at testing a popular strategy called the London breakout strategy. I'll be thoroughly testing it and maybe making some modifications here and there. So if you like day trading strategies, then that's one to keep an eye out for. I hope you've enjoyed this video. If you have, please give it a thumbs up and maybe subscribe to the channel. And until next time, this is Jared Goodwin, and thank you.